Some of the most damaging market abuse leaves almost no footprint. No fake news, no spoofed orders, just a trade placed at the right moment by someone who knew something. The market didn't. That's insider dealing, and its close cousin, front running. I've built the surveillance meant to catch both, so let me show you what they are, why they're the same trick, and how you spot them. Strip away the jargon, and both come down to one idea: trading on information the market doesn't have yet. You know, something price sensitive before everyone else, you trade on it, and you take a profit that was never really at risk. Normal trading is a bet on an uncertain future. This is a bet on a future you've already seen. The only difference is where the secret comes from. Insider dealing uses a corporate secret, an earnings miss, a takeover, a drug trial result. That isn't public yet. Front running uses a different secret, a big order that's about to hit the market. Know that a huge buy order is coming, and you know the price is about to move, so you step in front of it. Take a simple case. Fictional example, dummy numbers. An employee learns on Monday her company will announce a takeover on Friday, well above today's price of 20 euros. On Tuesday, she quietly buys 5,000 shares, 100,000 euros. On Friday, the deal is announced, the price jumps to 26, and she sells 30,000 euros of profit in 4 days. The trade looks ordinary. What makes it abuse is that it lines up perfectly with an event only a few people could see coming. Now, the mirror image. Fictional example, dummy numbers. A dealer is handed a client order to buy 500,000 shares, big enough that filling it will push the price up. Just before placing the client's order, he buys 10,000 shares for himself at 10 euros. The client's order goes through and lifts the price to 10 euros 40. He sells at 10 euros 35. 3,500 euros in minutes at no real risk. He just harvested the move the client's own order was always going to cause. One order, it's small. 1,000 orders, it's a business. Here's the part people miss. Under the market abuse regulation, when you're executing a client's order, that pending order is inside information, precise, not public, and certain to move the price. So front running isn't a separate lesser offense. In law, it's insider dealing. The secret just belongs to your client, not a company. Both break the same promise. Everyone trades on the same public information. The insider deals against whoever sold to them, blind to the takeover. The front runner makes the client's own order worse. The client pays more because someone jumped the queue. Small per trade, but a direct transfer to the person who cheated. So how do you catch it? The first signal is timing. For insider dealing, you line trades up against price-sensitive events, results, deals, announcements, and look for positions opened in the quiet window just before the news. For front running, you line a trader's own trades up against the client orders crossing the same desk, buying just before a big client buy, selling just after. Timing alone is coincidence until you connect it to the information. The second signal is the link. Who actually knew? Insider lists show who had access. Connected account analysis catches the trade placed not by the insider, but by a spouse, a friend, a second account. For front running, you tie the own account trade to the specific client order and desk. The third signal is whether the behavior fits the trader. An account that never touches a stock suddenly takes a large position days before news. You weigh size, timing, and profit against what's normal for that account. Winning right before the information goes public again and again isn't skill. It's a flag. Now the discipline. A well-timed trade is not proof. People buy before good news for honest reasons. A thesis, a chart, a rumor, plain luck. An alert is not a verdict. The analyst checks what the person could really have known, when the position was open versus when the information existed, and whether an innocent explanation fits. This isn't theory. In the Galleon case, U.S. authorities charged hedge fund founder Rajaratnam with running an insider dealing network. Corporate insiders fed him precise, non-public information, and he traded ahead of the announcements. In 2011, he was convicted on all 14 counts and sentenced to 11 years, the longest insider trading sentence at the time. He forfeited $53.8 million, and the regulator added a $92.8 million civil penalty. For front running, take the 2022 case against Lawrence Billimek and Alan Williams. Billimek, an equity trader at a large asset manager, tipped Williams about his firm's big, market-moving orders before they were executed. Williams traded just ahead of them and closed out once the price moved. More than 1,000 front-running trades between 2016 and 2022 coordinated on burner phones for at least $47 million. Billimek pleaded guilty and got 70 months in prison. The textbook shape at industrial scale. Good surveillance brings the three signals together: timing, the information link, and the abnormal profit, and routes the case to an analyst with the full picture. And it's not optional. Under the market abuse regulation, firms that arrange or execute transactions must have systems to detect suspicious orders and report them to the regulator without delay. My take, after building this many times, insider dealing and front running are one crime wearing two coats. Someone trades on information the market can't see yet, a company's secret or a client's order. The detection shape is identical: timing, the link, and a profit too clean to be luck. At GK Consultancy, we build and tune market abuse surveillance and train the people who investigate it. Get in touch at info@gkconsultancy.d. Thank you, and good luck for now.